Welcome back to Riding Academy. We are still on our series on adjustments. Okay, we have been looking at adjustments to the financial statement, that's to the final account, right? Now we've looked at accruals. Okay, we looked at accrued income and accrued expenses in our last class. Today we're going to be taking a step further. We're going to be looking at prepaid income and prepaid expenses. So we've looked at accrued income, okay? And I told you that when we talk about accrued income, we are talking about income that is due but not yet received. Or if it's accrued expenses, it is due but not yet paid, okay? That means in any of the ways, services has been rendered but value has not yet been given out or has not yet been received, okay? Now, in the case of prepaid income, when we talk about prepaid income, we're trying to say that income that has been received, okay, although the service has not yet been rendered. That is the difference, okay? So accrued income is income not yet received, even though service has been rendered. Prepaid income is income has been received, service has not been rendered. Are we together? And then prepaid expenses, the same thing. Expenses has the payment has been made, but the service has not been enjoyed. Okay, so you are paying in the simple thing is you are paying in advance or you are receiving payment in advance. Okay, prepaid income is receiving payment, income received in advance. Prepaid expenses, payment made in advance. So you have not yet enjoyed service, but you already made the payment. While accrued income, you have enjoyed the service or you have delivered the service, but you are yet to make payment for the service you have enjoyed, or you are yet to receive income for the service you have rendered. In terms of accrued income or accrued expenses, the thing is service is intact. What we are lacking is income. Okay, that's compensation. But in the terms of prepayment, okay, service is lacking, that is income is intact. Okay, so it is service that is lacking, so the dealings now will be opposite. Okay, because they are opposite of each other. The opposite of prepaid income is accrued income. Okay, now if you have income received in advance, if you're no longer in this case, they are no longer owing you. You are the one that is owing them. They have settled you. You are the one that who is yet to deliver your own. You are yet to play your own part. Okay, you are yet to play your own part. So you are the person that is owing. So prepaid income in this case is putting you in trouble. Okay, yes, that's what I'll use. It's putting you in trouble because at this case you have received money, you have not yet delivered the service, so you are owing. Are we together? And then prepaid expenses. In this case, the other way around, you are the person who has the upper hand because you have paid and you have not yet received this service that you paid for. So that means somebody else is owing you. Okay, that means there's an asset. People are owing you, have debtors. But in the case of prepaid income, there's a liability. You are owing people. Now let's look at the treatment. Like I said, whenever we come to our comprehensive income statement, all we want to reflect is income for the year. All we want to reflect in our comprehensive income, whether the income has been paid or not, we want to reflect the true income, okay, the true expenditure of a business in a financial year. That's what we want to review in our comprehensive income statement. So income prepaid is not true because as at the year end that service has not been rendered. So it means that particular portion of that prepaid income, that portion, okay, of the income that is prepaid, that amount is not income for the year because as at the year end that service has not been rendered. Okay, so we have to deduct that money so that we can arrive at our true net profit or net loss for the year. The same thing, expense is paid in advance. That service has not been enjoyed that particular year. Are we together? So if we want to show a true picture of expenditures for the year, since this particular service has not been enjoyed, we have to deduct the amount that was paid. So what we do in our comprehensive income, that we are going to deduct anything that has to do with prepaid income or prepaid expenses, so that we can have a true view of services that were enjoyed during the accounting year. So we're still going to be working on the previous question, but with little adjustment so that we can include prepayment. So we are still doing the accruals and then we'll be introducing prepayment in today's video. All right, so this is the same question we have from our previous class. And like I said, the only adjustment we made, which is going to be our focus for today, is when we come to additional information, we have inventory as at 31st December to be 350,000. We have commission of 150,000 was due but not yet received. And 50,000 naira. Okay, this was what I added. we have 50,000 naira was received in advance. That's commission of 50,000 naira was received in advance. Okay, and then we have accrued salaries and wages to amount to 80,000 naira than as at that date. Okay, and then I also added today we had general expenses of 3,000 naira was paid in advance. Okay, this is paid in advance, and then we have commission that was received in advance. Okay, so we are maintaining that commission, we are still maintaining the accrued commission, the one that is due but not yet received. And then I'm also introducing today that there's also a portion. I'm introducing today that we have an amount that was received in advance. Okay, and then of course we have general expenses that was paid in advance. So we're going to be looking at how we can solve this particular question. So the first thing we always do for our statement of comprehensive income, we always start with the date, the name of the business. Okay, so I'm going to start the name of the business, and then our business name is XYZ Limited. Okay, so this we are preparing for XYZ Limited. All right, I'm starting with the statement of comprehensive income. So this is comprehensive income statement for the year ended 31st December 2020, and of course our currency sign. So I'm working with naira, right? So we have our currency sign on the board. Quickly, we're going to be starting with all our income for the year, starting from the direct income and direct expenses. Okay, so we have sales and purchases. I'm not going to be dwelling much on that. Okay, I will just quickly solve, then I'll get to the where we have the adjustment in other incomes, then we can actually solve everything together. So this is already something we are used to, right? We have sales. We are always lessening returns inward from sales to arrive at net sales. Okay, and like I said, because sales is on the credit side, you always find your returns inward on the debit side. Okay, in your trial balance. So arrive at your net. When you less your returns inward, you arrive at net sales. Now your opening inventory will always be your trial balance. Your closing inventory is always outside the trial balance. Okay, then you have purchases given in the equation. We have carriage inwards which you add to purchases, and then you less of course returns outwards. After doing the adjustment, you arrive at net purchases. Okay, and then your net purchases as given here is 800,000. Okay, now when you add net purchases and opening inventory, you arrive at cost of goods available for sale. Then of course that's where you less your closing stock to arrive at your cost of goods sold. Once you've gotten your cost of goods sold, the next thing is to less that amount from your net sales. Okay, so that you can be able to have your total direct income, which we refer to as gross profit. So you're going to less this from your net sales, and you arrive at a gross profit 1,160 in this case. Now once you've gotten your gross profit, then we'll begin to add other incomes. Okay, now the other incomes we have here in our equation, we have discount received. There's no adjustment to that. Okay, and then we have commission received. Discount received was given to us 150,000. Okay, 150,000. Now when it comes to our commission, you have commission of 350 given in your trial balance. When we get to the additional information, we are told that, like I said, 150,000 was due but not yet paid. That's accrued income. And then I said today we are adding the second part, and then I said that 50,000 naira from that same commission was received in advance. So like I said, we want to reflect a true view. Okay, so what we are, the service we have rendered, and though we have not been paid, we include it, the value. Okay, but the service we have not yet rendered but we have received the money, we have to remove that money, because it means that service or that income is not for the service we rendered during the particular year. Okay, so we're going to be adding accrued income, and then we're going to be lessing prepaid income. Okay, we're going to less accrued commission accrued is 150. We're going to add it, okay, to the figure in the trial balance, and then of course we're going to less the 50,000, which is the what, the prepaid income received in advance, even though we have not yet rendered the service. Okay, so we're going to be having 350 plus 150,000, and then we are lessing the prepaid income for today, 50,000. Okay, so when we do the adjustment, we're going to be arriving at 450,000. So we can add this. So our total income here will be arriving at 1,760,000. Okay, now with this is our total income, so we can less our other expenses. Okay, so expenses as given, so we can less other expenses. Now, as given from our trial balance, we have expenses. I'm going to run through quickly. We have wages and salaries, we have stationaries, we have utility, general expenses, and then we have carriage outward. Okay, those are the item, our expenditure items. So we're going to quickly do that. Now, the adjustments we have here, we have adjustments for salaries and wages, and then that pertains to accrued. Okay, people have rendered service, but we are here to pay them. And then we also have today expense adjustments for general expenditure. Okay, it means that we have paid money even though we have not enjoyed service. That's what it means. Prepaid expenses. Okay, we have paid the money, we have not yet enjoyed service. Prepaid income, we have received the money, we have not yet rendered the services. We have wages and salaries. The value given in our trial balance is 20,000. Like I said, we have accrued salaries, okay, of 80,000. So we're going to be adding our accruals. You have 20 plus 80 to give you 100. Okay, 100,000. Now we have stationaries giving us 15,000. We have utility for 12,000. We have general expenses. Now, like I said, we are told that there's a prepaid expenses of 3,000 naira. So, because like I said, we want to reflect through income, through expenses for the year. Expenses that have been paid for but not yet enjoyed, we have to less that amount because that means that expense is not for the year, it's for the next year. When it will be enjoyed is the next year, so not this year. So we're going to be lessing that prepaid amount. Okay, so we're going to have 18 minus 3, and that will give us 15,000. And the next one we have is carriage outward. So we have carriage outward of 100,000. Now, so let's add our figures together. Alright, so that will be giving us a total of 242,000 as our total expenses. Okay, so this is our total expenses. Alright, so we have 242,000. We're going to be lessing this amount from the total income for the total net income for the year to arrive at net profit or net loss. When we let this figure, we're going to be arriving at 1,518,000 as our net profit. Now, what we are going to do is that we're going to prepare a balance sheet. We're going to prepare a balance sheet, not okay in the next video. We're actually going to reflect this balance sheet. Like I said, whenever we have prepaid income, we are lessing that income, then we treat it as a liability because we are owing people services. Okay, and then prepaid expenses is the other way around. We've paid, so they are owing us services. It's an asset for us. Okay, it's an asset to us. And then the other way around, whenever you have accrued income, is an asset. So accrued income and prepaid expenses are assets, whereas prepaid income and accrued expenses are liabilities. Okay, so we're going to be treating that when we get to statement of financial position. Don't forget to like this video if you haven't. If it was helpful to you, like this video, subscribe to this channel. Yes, subscribe to this channel. Click on the notification button so that when videos like this drop, you'll be notified immediately. Don't forget to share this video with as many as you can, those who you feel are supposed to enjoy what you have enjoyed or benefited. Okay, now we'll see you in our next class. Thank you.